Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, September 17th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host here for the next 30 minutes or so as we prepare for another market open. We do have the Fed beginning their meeting this morning, their Fed statement and also their interest rate decision will be announced tomorrow, Wednesday. That'll be at 2 p.m. Eastern. I find it very interesting that the S&P 500 has climbed all the way back up and is right now near a breakout to an all-time high. Seems to me like prices tend to gravitate to key areas right before a Fed meeting. Don't know if we're going to get the news we want to forge a breakout across the major indices, or maybe a false breakout, or maybe we just see intense selling right from the get-go and maybe never make that breakout. My guess is we're going to get a breakout, and whether or not it's sustained is probably going to go a long way to determining whether or not the market can kind of absorb all of the challenges that it faces as it heads through September and October, including, of course, the Fed announcement itself, whether we can get through with options expiration this Friday, whether we can get through during the typically bearish September, October months, and also even more so during presidential election cycles. September and October tend to be weak. So can the S&P 500 negotiate all that and continue to move up and have a sustainable breakout? That remains to be seen. Of course, it is absolutely possible. Market can do anything at once. It would be unusual to see that during this time of the year. I remain completely bullish on the long term, so I wouldn't be shocked. I mean, I'd be surprised by the timing, but I wouldn't be shocked by the fact that we break out, because I do believe we're going to see higher prices ahead. The question for me is whether or not we see a pause in between higher prices ahead and where we are right now. And so that's going to be what I would be watching with the Fed announcement. I would be watching rotation after the Fed announcement. I always like to, look at the various sectors and industry groups because that tells me a better story than CNBC. If we get the rate cut, and depending on what the Fed has to say, I should say when we get the Fed rate cut, because if we don't get a cut, that would probably be the worst scenario of all. Because at that point, I think Wall Street would make a statement that we simply don't trust the Fed. I think they've already made that statement clear. But after the Fed comes out and says it's time to change policy, if they don't change policy, I think that would be probably the worst of all scenarios as we look forward over the next month and into the end of the year. I'm pretty sure we're going to get a rate cut. My personal feeling is it's going to be 25 basis points. I think it's going to be more of a symbol than it is going to be anything that is obviously going to change the economy anytime in the near term. Normally, it takes a series of rate cuts before that even is felt in the economy. But the stock market will look ahead. So the stock market's going to take a look at what the Fed has to say, the course that they're planning to take going forward. In other words, is this just a symbol? We're just going to get a one-time shot, 25 basis points. Are they going to talk about a series that we are now looking at multiple rate cuts? Are they going to announce how many rate cuts? Are they going to announce the depth of the rate cuts? Are they going to just say we see a series of 25 basis point hikes and here's how many we think through the end of the year, and this is how many we think for next year? Do they leave it all up in the air and just remain somewhat ambiguous? I mean, that's possible. They might say, well, we think it's time to start cutting, but we do want to continue to watch data, so things are going to develop. I think all these things are going to go into the market reaction on Wednesday. And some of that would be good for the market, some of it not so good. I think if they're non-committal to how many rate cuts or the series, the size, I think that's going to leave some uncertainty in the market and room for much more volatility. I think if they're clearer about their path going forward. I think the market would probably like that because it would be eliminating some of the uncertainty in the market. But we don't know. I could speculate here all day. But I do expect a 25 basis point cut tomorrow. I do believe that we will see multiple cuts. I think we're going to have more than one before the end of the year. I expect that they're going to be on a rate cutting campaign next year. I would expect, because they have now turned the page on fighting inflation, that they're going to announce that they feel like they've conquered inflation, maybe still with one eye on the data. Those are some of the things I would expect the Fed to say. And where we go from there, I don't know. What I can tell you is that the retail sales numbers came in this morning better than expected. They were just released about a half an hour ago. And all of the major indices are higher in the range of about 0.4% to 0.6%. So things are looking up for the market here this morning as we wait for the Fed announcement. Again, my guess is that at the time of the announcement, we are probably going to be sitting on probably right on the cusp of all-time highs. That's what I would expect. I think we're heading in that direction right now. So certainly wouldn't be a shocker, I don't think, to be sitting maybe right on those highs or right near those highs when the announcement comes out on Wednesday. One other announcement, I will be on vacation after today and through next Monday. So Wednesday through Monday, I'll be out of pocket, traveling tomorrow, traveling back late Monday. So everything that I typically do at stock charts, at earnings beats, and I'm referring to mostly to our members right now, but mostly everything I do will not be done. One exception, we will have John Hopkins, my partner, who will be providing daily market reports each day. They'll be very brief, just to give you some idea of what's going on, what the Fed has to say, the market reaction, and so forth. I will be back next Tuesday, so I will start the daily market report again next Tuesday. Obviously, there will be no live trading room on Wednesday, tomorrow, because I literally will be on a plane. I don't know how to orchestrate a live trading room from 30,000 miles up or whatever, 3,000 miles, whatever. There are 30,000 feet. That's it. Never mind. Not that many miles. 30,000 feet. I don't think I could do a live trading room. So anyway, that will be postponed till the following week. Weekly market or weekly portfolio report will be delayed a week. All the chart lists won't be updated until next Friday. Anyway, just want to make sure all of our members know this show will be done next Tuesday morning, so won't miss any of the Tuesday shows. The stock chart show on Thursday that I normally do is not going to be done. At least there's still the possibility, if I have time, I might record it this evening, but chances are you won't see that on Thursday as well. So just going to be a light week as I take some time off, recharge the batteries, get ready for what should be a pretty interesting fourth quarter ahead. So anyway, just want to make sure everybody's aware of that. Okay, with all of that, let me go ahead and pull up what happened yesterday in the market. So we started off the week with the Dow Jones gaining 228 points. That was up about 0.5%. S&P 500 went up, but much less, gaining just a little bit more than 0.1%. NASDAQ actually took it on the chin. We saw money rotating away from technology yesterday, some of the more aggressive areas. So last week was all about growth. The week before was all about value. This week started off about value. That's going to be one of the key rotation things that you're going to need to watch. When we do get the announcement, if the market goes up, check to see after the announcement, after 2:00, what happens among the various sectors, what happens among the various industry groups. Where does the money flow? That's more of a story. I'm telling you, that's more of a story than you're ever going to get on CNBC. That's going to give us a lot of clues about, are the cyclical stocks leading? Are the growth stocks leading after the announcement? That's going to be important in terms of trying to determine whether or not a potential breakout is sustainable. If we get a breakout and you see the four defensive groups on top, I would be very cautious about that type of a breakout. I think if you get a breakout and you see technology and communication services and discretionary stocks leading to the upside, that's going to be a market that, may simply have some sustainability to it. That could be not only a breakout, but maybe we're not going to see the September, October swoon that we normally see. Listen, I've talked about being cautious these months. I think it's prudent to talk about being cautious because historically, this is the worst time of the year. This is the time. I mean, you can go back and you look at a lot of aggressive areas that tend to really cool off September, October. Many of even small caps, which haven't been that hot to begin with, they really struggle toward the end of September and even into the early part of October. So there's a lot of different areas of the market that historically do not perform well. That is not my opinion. That is a fact that goes back. It's just seasonal trends. It's not a guarantee, but those are seasonal facts that if you go back to 1950 on the S&P 500, you see that kind of behavior in the market. So it's something, it's almost like a self-fulfilling prophecy. So if the market starts to turn lower, I believe there's going to be a lot of folks saying, okay, here we go again. And it could be some piling on. Watch the volatility index. Yesterday, we had mostly upside action. Dow up over 200. VIX was rising again yesterday, back up over 17. The VIX is still in that area where it could go either way. And when the VIX goes back up above 20, if it goes back up above 20, that's when we tend to see those impulsive moves to the downside, where you're like, okay, well, we're coming up upon support. Whoops, there went support. It's not like normal trading behavior when the VIX is high. So just recognize if that VIX gets back through 20 again, I would batten down the hatches and just be prepared for what could be a short-term storm. Think about, hurricanes coming in toward the East Coast. The hurricane itself is devastating. Doesn't mean the rest afterwards is going to be devastating, but the hurricane itself coming in, you want to be careful. You want to kind of move away from the shore. That's what I'm talking about with the VIX. When the VIX gets up above 20, doesn't mean that we're in a secular bear market all of a sudden. It just means that short term, you better batten down the hatches. So watch the VIX, listen to the Fed, watch the reaction. All of those things are going to be really important as we go throughout this week. And remember, options expire Friday, as if we needed something else to kind of increase or decrease the volatility. Remember, if we break out to all-time highs, there are going to be almost no in-the-money puts. So it's going to be all about in-the-money calls as we head toward option expiration and even into the early part of next week. That presents risks in itself. Short-term breakout, all-time highs, options expiring. It would be in the market maker's interest to see a reversal and a move back to the downside in order to save a lot of option premium money. Anyhow, and that's more so, we did our Max Pain event last night. That's more true on the NASDAQ and the Russell 2000 than it is on the S&P 500. I don't have time really to go into that, but we do have recordings. So if you check out a 30-day trial at Earnings Beats, you can go back and listen to the recording from last night. But there is one unusual thing with options this month, particularly on the S&P 500 that everybody should be aware of. Anyhow, let's move on, talk about sectors. So yesterday, financials, there's financials, energy. We do have communication services up a little bit, materials, utilities, healthcare, industrials. These are all value-oriented, more dividend payers, more defensive. Financials, I don't call defensive. I think they're still part of the aggressive groups, but they're the defensive part of the aggressive groups, if that makes any sense. They're very, it's just this particular group, it responds from a cyclical perspective, if you will. So it's they're going to react more toward economic activity or what might happen down the road with economic activity. So keep an eye on that group for sure, financials and industrials, after the Fed announcement on Wednesday. Anyway, for the day, though, financials gaining the most, up 1.3%. We've been seeing a lot of relative strength in financials really over the past couple months. And I'll show you that chart in just a minute. Energy, talked about energy last week. It looked like maybe we were reversing and that energy might gain some steam for a while. Well, I think that's what's happening. I think energy looks pretty interesting here this week, at least until it gives us some other signal and reverses back to the downside. I believe it's starting to trend back up, and I'd stick with it until it tells us otherwise. Down to the downside, this is what I was talking about. Technology, consumer discretionary, the two aggressive groups, leading last week, lagging yesterday. So is that going to be the theme as we go into the Fed meeting, and after the Fed meeting, and after the what should be a rate cut announcement? What happens to technology? It's going to be a really important thing to watch. All right. That's the sector summary for the last day. Now, if we wanted to look for the last week, this is what I was talking about. Here's technology, communication services, consumer discretionary. These are the groups that tend to lead, or that almost always lead, secular bull market advances. So if we break out on Wednesday with the Fed announcement, we continue moving up, later in the week, watch these three groups. These are the three keys, in my opinion. If they lead it to the upside, you have to respect it. Doesn't mean the breakout holds. Nobody knows ever whether a breakout's going to hold or a breakdown's going to hold. But I would continue to watch their relative performance, because they will give you probably the biggest clues as to what we may see coming down the road. Technology, or the 10-year Treasury yield. Let's get a quick update here. Again, as I said, we had some strong economic news in terms of the retail sales number. Let me give you that for the month of August. Now, of course, we're not too far from going into October, so it is a little bit in the rearview mirror. But going in or looking at this August retail sales report, the actual number was only a rise of 0.1%, but the market was expecting a decline of 0.3%. So that was the headline number. That was good news. Also, in the prior month, so for July, there was a revision higher. So July retail sales came in rising 1%. It was revised slightly higher to a gain of 1.1%. Now, before we go any further, I need to talk about what happens when we strip out the vehicles, because all of a sudden it wasn't quite so good news with the August retail sales if we exclude vehicles. So the actual was, again, a rise of 0.1% for August, but the market for that category was expecting a 0.3% rise. So we came in slightly below expectations there. Anyhow, you can see the market's reaction. Big yawn. We've got the 10-year Treasury yield up 1 basis point to 3.63% from yesterday's close at 3.62%. And we're still sitting down here at a 52-week low. So at least initially, not much of a reaction to what I would consider to be maybe a better than expected report. Not huge, but at least slightly better than expected. Let's see. Later this morning, this will be happening in about, actually, it just came out. Let me see if I can get a number for you on the industrial production. Yep. August industrial production, huge increase here. 0.8%, the actual versus the consensus estimate of 0.1%. So really big beat there. We did revise July's numbers down lower, though, on industrial production. Instead of a 0.6% decrease, we had a 0.9% decrease. So 0.9% in July decrease, 0.8% increase in August. They kind of offset, but at least it didn't go in the same direction. I think if we had had another big down month, then I think you would have started to hear more and more talk about a recession, and that might not have been considered as good news. But anyway, the capacity utilization last month was 77.8. That was revised lower to 77.4. And the current month was expected to be, or August was expected to come in at 77.9. We came in at 78. So just above expectations. So let me see if anything changed in terms of the pre-market. The diamonds still up about 0.3%. Spider up about 0.4%. QQQ up 2/3%. That actually is a little bit higher than what we saw earlier. And the IWM has dropped considerably. It's actually, I don't know if that's correct or not, but right now it's showing flat, and that was just up over 0.6%. So it looks like if there was any reaction to the news, it was actually small caps, which fell back and lost its pre-market gains. Anyway, we'll know a lot more when the market opens in about 11 minutes, but that's where we stand right now. S&P 500, you can see on the chart, if this was any other month besides September, I would be looking at this chart very bullishly. I'll be honest. I mean, we've got equal highs, we've got rising lows. It's certainly set up for a potential breakout of an ascending triangle, but it hasn't broken yet. We do know that there are issues out there, like the fact that it's September, October, the fact that we do have a presidential election coming up, which normally there is some uncertainty over that. And market doesn't like uncertainty, and usually it gets a lot of it in September and October. So the S&P 500 here on the chart, and remember, for me, there's nothing more important than price action, price and volume. So if we get a big breakout, go to all-time highs, the volume's heavy, and it's led by technology and consumer discretionary and communication services, and maybe to a lesser degree by financials and industrials. If those five groups are on top and we make a breakout, it's hard to ignore that. That's a very bullish development. So until it reversed, kind of like what I was talking about with energy, if it's telling you that you want to be long, then you want to be long until it reverses and says head fake, which is possible as well this time of year. It's a difficult period, I understand, and it's not easy to kind of feel comfortable with any position. The only thing I would say, and that I've been saying, is that long term, I really like the market to go higher. I've said that for 12 years now. I've said it ever since this secular bull market began. I've recognized the cyclical bear markets that we've had, the corrections that we've had, but I've said during every single one, the market's going to come out of this and we're going to all-time highs. I'm saying the same thing. Whether the market goes up or down in the short term, in my opinion, the market's going higher later this year and into 2025. So we'll see. Is there something that could change my mind? Yeah, full out recession. Maybe a deep recession. Listen, we're going to get signs if that happens. It's not just going to happen overnight. Some might argue we've already got some signs, and I wouldn't necessarily disagree with that. I mean, we got technology, which is nowhere near its high, even though the S&P is near its high. So rotation still favors the possibility of a recession, maybe a small one. But you still want to watch the breakouts and the price action. If we get that breakout and the volume's there, it's really a difficult position to be in to keep betting against a market that's setting all-time highs. That usually gets you in trouble. Anyway, NASDAQ 100. So this is, you just saw the S&P on the brink of a breakout. Look at the NASDAQ 100. The breakout level is up probably close to about 20,700. We're sitting at 19.4. Right now, we're down probably 6 or 7% from the high established in July. So I don't think we're going to see a breakout, but what I would like to see is continuing outperformance by the NASDAQ 100 over the last week or so. That's what we've been seeing. So if we get a good report or a good, if the announcement comes out from the Fed, we get the rate cut, the market loves what the Fed says, and we keep moving higher, does the NASDAQ outperform? If it doesn't, I think that's still a signal that we have to be somewhat cautious. In other words, for me, I just simply wouldn't trade the NASDAQ. If the S&P 500 is breaking out, why not trade what's breaking out? And if you can zero in on the areas, like maybe it's financials, maybe it's industrials, why not just follow where the money's going, where the leaders are? So anyway, a lot to think about. I know it's a tough period. I sympathize with all of you because it's been hard from our side. For me, just trying to call the market, it's been difficult. So I know someone who's out looking at the news, talking to friends, in the evenings, having dinner, talking about the market. It's really difficult to figure out what it's going to do here in the short term. IWM, you can see kind of like technology, it has a high here, a lower high, very similar to what we were talking about just with the NDX, high, lower high. So it's not all S&P 500 where we got this nice bullish pattern and we're up near all-time highs. That's not really what the overall market's doing. It's what certain areas of the market are doing. We're getting really good leadership these past few months from many of the more value-oriented stocks. And these were stocks, by the way, that were lagging for a long time. It's the same reason why folks didn't, you'd hear all the stories. Well, there's no breadth. The breadth is horrible. And so this is not a good rally. We don't want to be long. And now the market's trying to break out with breadth. And people are saying, well, technology, it's not going anywhere without technology in the semiconductors. It's like pick an argument, folks. Which one is it? Is it bad no matter whether we have good breadth or bad breadth? Because that's what it sounds like. And honestly, that's what I get when I listen to the media. I just am constantly being told that this is not good, that this is a reason why the market's going to pull back. Oop, nope, not that reason anymore. Now it's this reason. Oh, not that reason. You watch. We're going to hear a lot more. If we top and we start going back down and the inflation's in check, everything's going to be about a recession, potential recession. And you're going to start having to read article after article after article after article about how things are going to be horrible in terms of the recession. People are going to say, well, rates are declining. Last 2 times we've had significant rate declines. They were associated with the bear market, 2000 and 2007. All I would say is take a look at the rest of history, because I think most people realize 2 times is not really a representative sample. Look at how the rate cuts have gone down over the last 50 years, and then get back to me about trying to generalize where the market might go simply from 2 times in history. Anyway, I could make a show about that, but no time today. Transport's moving back up. Again, I mean, do you see a trend? I see what appears to be the start of uptrends and the start of downtrends, but I see no follow through in either direction. So what we're left with is just a series of ups and downs in sideways consolidation fashion. Need to do more work to get a breakout here in the transportation area, but that would be a very, very bullish signal if and when we get a definitive breakout in the transports. I know a lot of folks thinking, oh, this is bearish. The transports haven't followed the Dow. We think about the Dow theory. The Dow set an all-time high. Transports haven't. What I will say about the transports is that if you look at them on a 5-year chart, you see a big uptrend followed by a lot of sideways consolidation. That's not bearish. They may not be getting all the love that the rest of the market's been getting, but they're not breaking down. And if you go out to a monthly chart, tell me what you see, because I see a really long, really nice uptrend that accelerated once we took out the prior highs in April when the S&P 500 broke out. Look at what happened afterwards for the next year and a half on transports. If the transports make a breakout, I think they'll be one of the best areas to trade. I think the overall market would be in great shape. I don't think transports are going to lead, but I think transports are going to perform extremely well. And I think that's going to be part of a much bigger advance in the overall market. Moving on. Okay, let's see. If you go over to earningsbeats.com, this is my home. If you want to learn more about the market, we have a free, no credit card, unsubscribe anytime. It's a free Earnings Beats Digest newsletter. I publish Monday and Wednesday every week. And as a result, you can be getting information about the market, about maybe individual industry groups, individual stocks. It might be about sentiment, relative strength, upcoming earnings reports, all of those things we talk about in various articles in this newsletter. And again, it's completely free, no credit card. So name, email address, make sure you get signed up. If you want to try our service for 30 days, now is going to be a great time, because we're going to walk you through what has historically been one of the worst periods in the market. Mid-September to mid-October, market normally isn't very strong, especially the latter half here of September. And then there's actually another week in October that we need to be on guard about. Anyway, start a no-cost trial, 30 days for free. If you don't like it, cancel. It's that simple, and you won't be charged. We'll even remind you that you're coming up for renewal, so you'll have no excuses. If you don't like the service, that's fine. We understand we're not a fit for everyone, but you won't know until you try us. I want to talk about a chart today. GE, you can see GE making this breakout right here above recent sideways consolidation. We made the breakout on Friday. We followed through yesterday. I think the best entry is going to be on a 20-day test somewhere down the road, but it is just breaking out. And sometimes these stocks run for a while before we see pullback. So wanted to point that one out. Looking at The sector relative strength, I told you I was going to talk about that. Here is the XLK relative to the S&P 500. So when this is going down, it doesn't necessarily mean that technology is going down. Technology could go up. It just could be that other areas of the market go up more and carry the S&P the upside. So when you're looking at these relative charts, don't think, oh, technology is getting roasted to the downside and they're losing a lot of money in technology, because actually we're now probably about, I don't know, 5-6% off of the recent low. So technology's been rebounding. The problem is it's just not been rebounding to the point where it's outperforming the S&P 500. So we're continuing to put in a series of lower highs on technology, which is simply telling us this is not the area that's leading the market. Yes, it led last week. Maybe it leads today. I don't know. We'll find out. But clearly, since back in the early part of July and maybe even the middle part of June, kind of when semiconductors topped, that was on June 22nd. Since that period, since that day, technology has struggled on a relative basis, and it's not going to get any better until semiconductors start to move. Semiconductors are, I believe, 50% of the XLK. So technology is not going to go without that group leading it to the upside. So anyway, just kind of keep that in mind. I wanted to show you industrials. So industrials had been very weak until we got to June, July. Look at the strength that we've seen in this area. Will it continue? I don't know. What I can tell you is that industrials have broken out. They're now trading at all-time highs, whereas you saw the technology group is not. So you can look at this and say, well, yeah, industrials are downtrending, but what I see is a breakout, leadership, and it's important to note, industrials really like the fourth quarter historically. So we're going into the fourth quarter, and this is when industrials tend to do very well, especially the month of November. I think industrials have been up something like 15 of the last 16 years during the month of November. So we've got a really strong month coming up for industrials. If we continue to lead going into November, obviously that would just be bonus points. But this is the time of the year when industrials tend to do well. Same thing for financials. So here, financials making this big move since mid-June, early July, and broken out to about a 4, well, let's see. I was going to say 14, but I think it's more than that. So yeah, it's probably more like 18-month relative high on financials. And I can tell you a couple of things. Fundamentally, I think those smaller banks will love rate cuts. Been waiting for them for a long time. And many of the financial areas will do better with rates coming down and the economy improving, because many of the financial areas are cyclical in nature, as are the industrials. So that's why I think it's important to watch to see how these groups do when the announcement comes on Wednesday, tomorrow. I just wanted to kind of go through, I'm going to go through these really quickly, but I wanted to go through the industrials and the financials. I know we're 3 minutes into the market, but I want to just show you how these various industry groups are doing relative to the S&P 500. And so until I tell you otherwise, these are all industrial groups. So you can kind of see coming off of lows. This is the truckers. Then we got business support services. Look at that rise. You got diversified industrials. Look at what's been going on here. Industrial suppliers made a big move back in July, pulled back, now starting to turn back up. Let's take a look at the defense group. July low, we've been trading higher on a relative basis. Heavy construction moving to about a 3-month relative high. Industrial machinery bottomed at the beginning of July, made a big run that month, has pulled back, trying to turn higher. We'll see what happens there. Railroads. This is a group that was really in, struggling back beginning of July. Nice rally over the last couple of months on a relative basis, hooking back up again yesterday. We'll see what happens. Let's see if railroads continue to be strong after the Fed announcement. Marine transportation actually has been down. It was actually going up prior to when all the aggressive groups started to take a back seat, and it went down with them. So I would probably ignore that one. Then you've got building materials and fixtures. Look at what's happening. We're getting ready to get a relative breakout after 3 strong months here. Aerospace bottomed in the second week of July, been moving up. It's got a little bit of relative overhead resistance to watch here. Then we've got commercial vehicles moving up on a relative basis, maybe to a lesser amount, but still moving up. This is one that hasn't performed as well. This is your delivery services, actually setting a new 52-week relative low recently. Airlines, really not doing much. June, July, really not good at all until we got to August. Then we bottomed, seeing some strength now over the last month or so. But that one not as good as some others. Here we got financials. These are the financials. Look at the insurance stocks. These are property and casualty insurance. Beginning of July, absolute strength, going straight up. Then we've got mortgage finance. Boom, straight up. Insurance brokers, nice rally. Relative. This, again, this is not the groups moving up. This is the groups moving up relative to the S&P 500. So if the S&P 500 is going up, it means these groups are going up even more. Sometimes it can mean the S&P 500 is getting trounced. And if you've got relative strength, it just means maybe you're going down, but you're not going down as much. So again, it's relative. It's not absolute price action, but it is rotation. This is the best chart. These are the best charts to look at in terms of rotation. RRG is a great way to look at rotation visually as well. But when the lines are going up for that particular group, it means it's outperforming the S&P 500. It's getting more than its fair share of money rotating into it. Then we've got financial administration bottoming in July. Look at this thing been going down and down and down and down for years. And now all of a sudden, the last 3 months, we've gotten some strength. The reinsurance bottomed beginning of July, showing relative strength. How about consumer finance? Big move up since beginning of July. Investment services. And this is stuff that I talked about back when we got that June CPI report in mid-July. And I said, hey, rotation. It's all about rotation. Money is rotating into areas that would be supported by interest rate cuts. And really, we haven't seen anything change just yet. So that's why it's important to watch what happens after the announcement on Wednesday. Investment services have made a push back to the upside, although beginning of September, not so great. Full line insurance. This is an area that has not performed well, continues to move lower. So would I be jumping into full line insurance? No. Go where the strength is. We're momentum traders at Earnings Beats. We want to be where the strength is, not where the strength isn't. Just because it's in financials doesn't mean we're just going to, give it a blanket check, to go long. Still got to see strength in these areas. Banks. Now, banks bottomed in June, made a big run through the middle of July, breaking out to more than a 52-week high, has pulled back, but now starting to turn back up again. It's going to be very interesting to see what happens to banks, especially smaller banks. If, in fact, we get a rate cut and the market or the Fed starts talking much more dovishly. Specialty finance. You can see recently that was a huge move on a relative basis, breaking out above all these highs. We pulled back, and I think it was specialty finance that I just talked about in yesterday's EB Digest. I think there was a specialty finance company that I talked about. I'm trying to think which one it was. But it was because of looking at this chart and seeing such big strength, a breakout on a relative basis. Then we had last week where everything rotated back to technology. This area went through some profit taking. But this, again, financials love the fourth quarter coming up. So I look at this as an opportunity. When I see a group that's leading, heading into a period that historically is bullish, and it gives us a week of selling and some pullback, that's when you don't really want to chase. You want to get them on pullbacks when you can. And so I think that's the opportunity here with specialty finance. Asset managers. Look at this, breaking back out to the highest level we've seen off of that July low, and not too far away from the December high that we saw last year. Breakout there would add more bullishness to the chart. Life insurance. Last 2.5 months, moving up on a relative basis. And then that's it for financials. Anyway, I just wanted to point that out so that you can see visually what has been taking place since July? Yes, technology bounced back last week. Maybe it soars with the Fed. We don't know, but watch it. Because if we continue to see technology roll over, remember, that's over 30% of the S&P 500. It's going to be very difficult for the S&P 500 to explode to the upside if it doesn't have leadership from technology. Anyway, let's see what the market's doing. We are now 10 minutes in. I apologize going over. We are seeing the Dow up about 1/4%, S&P 4/10, NASDAQ 2/3, small caps 3/4. That may have just been some kind of an error pre-market. I don't know. Yeah, IWM not even trading near where it was yesterday. It's up about 2/3 of 1%. So must have been some kind of a glitch when I was looking at the IWM earlier in pre-market. I was surprised. But anyway, can it continue to move higher? Notice we are getting a lot of gap ups here. So is it kind of, is all this kind of being forced to the upside? Is it a little bit of manipulation right before the Fed announcement, right before maybe another move to the downside? I don't know. Let's look at the S&P. Last thing I want to see, let's use the inspector so I can give you the exact number on the all-time high close, 56.6720. Today's high was 56.5983. So today's high, we got within 10 of the all-time high intraday. We got within 8 of the all-time high close. So just remember 56.6720 is the close that we're watching on the S&P 500. If you're an intraday fan, if we print 56.70, it's an all-time high on the S&P. So we are right there. And right as the Fed starts its meeting. Isn't that a coincidence? Anyhow, that's I'll be watching it from afar. Looking forward to a vacation, getting away from the market for a little while, although I'll still have my phone. So I will be checking things out for sure. You can bet on that. And if I do see anything that is noteworthy while I'm on vacation, I will be in touch with John Hopkins so he can pass it along to everyone. Anyway, that's where everything stands right now. So have a great rest of your week. Enjoy your upcoming weekend. I will be back next Monday evening, so I will be here for Trading Places Live next Tuesday. I will see you then. Happy trading, everybody.